You're listening to AI PRISM from Seoul Economic Daily.
It's Thursday, May 14. I'd like to share some thoughts about finance daily. If you're watching Korea's financial system right now, you are seeing this, a really bizarre trifecta playing out.
Yeah, definitely. It's an interesting moment.
We've got this government debt relief lifeboat that's legally locked shut, ghost town warehouses draining bank capital, and a massive billion-dollar fine that practically vanished into thin air.
Right. And when you step back, these three pressure points tell a really fascinating story about where capital flows and, crucially, who gets thrown a lifeline when the system cracks.
Exactly. Let's start with the people getting jammed. Right now, there's a record 18% unpaid ratio for income contingent student loans.
Which is huge.
It is. And just to be clear for you listening, these are loans where you only make payments if your income crosses a certain threshold. So an 18% unpaid rate means almost 1 in 5 borrowers isn't even making that baseline income.
Yeah, and the average overdue balance is 1.41 million won, which is about $1,000 US. It's a serious localized crisis.
Right, but the government actually has a mechanism for this, right? The new LEAP fund.
Exactly. It acts as a state-coordinated bad bank. It buys distressed personal debt from private lenders at a steep discount, and then, it forgives up to 80% of the principal.
Wow, 80%. And private financial firms have already taken a haircut here, right? They offloaded like 7.7 trillion won, which is roughly $5.4 billion US in troubled debt.
They have, yeah. But here's the catch. The Korea Student Aid Foundation, which holds about 25 billion won, or 17 million US dollars in these troubled student loans, hasn't sold a dime to the fund.
Really? The government has the money, private lenders are using it, but the students are just left out. Why?
It's literally a legislative oversight. In Korea, public agencies like the Student Aid Foundation need explicit legal authorization to sell debt to another government entity.
Oh, don't tell me.
Yep. The temporary legal clause that allowed them to do that lapsed years ago. Nobody renewed it. So the agency is just legally paralyzed.
Okay, let's unpack this. It's like the government built a state-of-the-art lifeboat for borrowers, but lost the legal key to unlock it for students.
That is precisely what's happening. And the structural irony here is that while young retail borrowers are trapped by a simple paperwork glitch, the major banks are facing massive, complex structural headaches of their own.
And they might actually get bailed out. Which brings us to the empty warehouses.
Right.
Look at Woori Financial Group. Their troubled credit exposure recently doubled to 578 billion won, which is around 408 million US dollars. And a huge chunk of that, like 32%, is tied entirely to logistics centers. Why does a massive bank suddenly care so much about warehouses?
It comes down to how these projects were funded. We're looking at project financing, or PF.
Remind us how that works in Korea.
Sure. Lenders extend these non-recourse loans based on a project's future cash flows, not the underlying corporate assets.
Ah, got it. So during the pandemic e-commerce boom, developers went crazy building cold storage centers.
Exactly. And banks jumped into these PF syndications because they projected just, endless rental income.
But the e-commerce surge cooled off. The future cash flow they bet on just doesn't exist.
It doesn't. Today, a staggering 37.3% of cold storage facilities in the greater Seoul area are sitting entirely empty.
Over a third are completely empty.
Right. And no tenants means no cash flow, which means those non-recourse loans go bad. You can see the contagion spreading. The Industrial Bank of Korea just saw their delinquency rate on small business real estate loans hit 1.28% in the first quarter.
Okay, so the banks are eating these severe logistics PF write-downs. They really need a break.
And magically, they just got a massive one from the regulators.
Let's talk about that. Because to grasp why this matters, you have to understand the two-headed nature of Korean financial regulation.
Right. You have the Financial Supervisory Service, the FSS, which handles on-site inspections, and then the Financial Services Commission, the FSC, which sets policy and actually godfathers the penalties.
Right. And the FSS, the inspectors, proposed this colossal 1.4 trillion won fine. That's about 990 million US dollars against 5 major banks for mis-selling Hong Kong index-linked products.
But the FSC, the approval body, rejected it.
Wait, they just said no?
Basically, yeah. They sent the draft penalty right back to the FSS, demanding they revisit the facts and their underlying legal reasoning. This kind of open pushback between the two agencies is really rare.
So what's the real takeaway for you as an analyst watching this? Why does this regulatory rework matter?
It signals a crucial shift in headline risk. By rejecting the maximum fine and demanding a rework, the FSC is transforming a severe regulatory crisis into a manageable, likely much smaller settlement.
Oh, I see.
Yeah, and it gives the banks crucial capital relief at the exact moment those cold storage logistics losses are mounting on their balance sheets.
It really makes you stop and think. As major banks secure rapid regulatory relief to protect their balance sheets from bad real estate bets, you have to wonder if lawmakers will show that exact same urgency to fix the legal glitch trapping those young student borrowers. That's today's AI PRISM, Finance Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a WAN-IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.